Hello viewers, welcome to my channel. I'm Hasham. Now I'm going to start the video on the theory, complete theory about the advanced accounting. I got many requests from the regular viewers, from students to make a video on the complete theory of the subject advanced accounting. The exams are very near. So nowadays question paper is set in such a way that 30% is completely theory. Only 70% are problems. So a student cannot focus only on solving the problems. He must have the ability to write the theory question as well. So he can write only when he knows the concepts which are used in different topics. So I have decided to give a video on the complete theory of all the 5 units of the subject advanced accounting. So watch the video till the end. The video may be lengthy, but it will be for your benefit only. If you watch with full concentration, the points you can be able to write all the points in examination with confidence. Not only from examination point of view, but also throughout your life you can be able to remember. It will increase your knowledge on the subject. So the 5 units which I'm going to cover up in this subject of advanced accounting are: first one, partnership accounts. In this, admission, retirement, death of a partner, I'm going to explain in detail. Second unit, partnership accounts 2, dissolution of firms and sale to a company. Unit number 3, company accounts, issue of shares, debentures, and underwriting, bonus shares. Then 4th unit, company final accounts. And lastly, 5th unit, valuation of goodwill, valuation of shares. I'm going to explain all these things in detail. So keep watching, don't skip the video in between and watch till the end. Now I'm going to start our topic now with partnership accounts 1. First of all, explain the meaning of the term partnership and its features. A partnership is a form of business organization. According to Indian Partnership Act 1932, a partnership is the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. This definition given by Indian Partnership Act 1932 contains all the features of partnership. It says that it is an agreement. Without agreement, no partnership. It says when 2 or more persons, that means no single person can form a partnership. It is made to run the business. It is made to share the profits of the business. It will be carried on by all the persons, by all the partners collectively. Every partner has the right to take part in the conduct of the business. All these are the ingredients. Features of the partnership firm. A partnership firm requires at least 2 persons, minimum 2, maximum 50. A partnership firm is made with the agreement. No agreement, no partnership. A partnership is made to conduct the business. The business must be carried on by all the partners. The profit sharing ratio should be specified. That means the purpose of running the business is to share the profits and losses. This is partnership. Next comes explain the methods of maintaining capital accounts, fixed capital account method and fluctuating capital account method. So from accounting point of view, there are 2 methods of maintaining the capital accounts of partners. First method, fixed capital method. In this fixed capital method, the capital of the partners will remain fixed from beginning of the year to end of the year. The partner's capital will not change. Then all the adjustments will be done in a new account called current account. So 2 accounts will be made for every partner. One capital account, one current account. Capital account will remain same, intact. All the adjustment regarding profit, regarding salary, regarding commission, regarding interest on capital, drawings, all these adjustments are made in current account. In current account. This method is called fixed capital method. Second method is fluctuating capital method. In this method, the capital will fluctuate because only one account we are maintaining for every partner. And in that account only we are going to make all adjustments regarding salary, share of profit, then interest on capital, commission, remuneration, etc. All the adjustments are made in one account. It is called fluctuating capital method. Next comes explain profit and loss appropriation account. It is an extension of profit and loss account. See, in a sole trading concern, whatever profit they get, the complete profit will be transferred to capital account. In case of sole trading concern, because only one person is there. But in case of partnership, we have two or more than two number of persons, partners. In that case, after making profit and loss account, another account is prepared called profit and loss appropriation account. That means division of profit. The profit which we get in P&L account will be transferred to appropriation account. The appropriation account credit side, we take the profit as per the P&L account. And in this account, credit side, we take interest on drawings. Debit side, we take interest on capital, salary given to any partner, remuneration given to any partner. Then the balance of profit is called distributable profit, and that will be distributed among the partners in the profit sharing ratio. That is called profit and loss appropriation account. Next comes rules regarding interest on drawings. Drawing means when the partner has withdrawn the money for personal use. So what are the rules regarding interest on drawings? Suppose if the date of drawings are given, we can calculate easily how much is the interest on drawings. If the date is not given, we assume that drawings are made in the middle of the year, so we calculate 6 months interest. Assuming that drawings were made in the middle of the year, the total drawings we calculate for 6 months. Sometimes the drawings are made evenly throughout the year. Evenly throughout the year. That means every month the partner is withdrawing. In that case, we have to see whether he is withdrawing beginning of the year or end of the year. If the partner is drawing the money at the beginning of every month, so we take the total drawings during the year into 6.5 months. Interest will be calculated for 6.5 months if the drawings are made in the beginning of the year. If the drawings are made at the end of the year, then 5.5 months. End of the month, sorry. If drawings are made evenly throughout the year, at the end of every month, then we calculate 5.5. These are the rules regarding interest on drawings. Actually, the terms and conditions of the partnership are contained in a document called partnership deed. All the terms and conditions are written. But sometimes if the partnership deed is silent, then the provisions of Indian Partnership Act will apply. So according to the provisions of Indian Partnership Act, the profit sharing ratio will be equal. If the deed is silent, then Indian Partnership Act says all the partners should share equal profit. Secondly, no partner should be allowed any salary or any remuneration. The partner will get only share of profit. No partner will be charged interest on drawings. Every partner has a right to take part in the conduct of the business. All these are the terms and conditions which will be applied if the partnership deed is silent. Next comes admission of a partner. Sometimes the partnership firm requires more resources and the present partners are not in a position to provide further resources, further capital. So they may invite a new person to become a partner in the partnership firm. Then adjustments have to be made in the accounts when a new partner is admitted, right? In order to grow the business, the old partners wants to, allow another new person to enter into the partnership firm. So what are the adjustments? Matters to be considered on admission of a partner. If a new partner is admitted, then what are the things? Treatment of goodwill. First adjustment is treatment of goodwill. Goodwill means the reputation, the good name of the business. When a business is having reputation, good name, definitely its earning capacity will be more. The profitability will be more. Suppose ABC are running the business for the last 10 years. They are having good reputation. The profitability of this business is high. Now during the current year, a new partner D is admitted. So automatically D is also getting the benefit of the efforts of A, B and C. So what A, B and C will tell to D is, we will allow you to become a partner in our partnership firm provided you have to pay some goodwill to us, goodwill to the firm. Then only we'll allow Mr. D to enter into the partnership, because in future he is going to get the benefit from the efforts of the old partners. So that is goodwill. The goodwill will be brought by the new partner. So how to treat the goodwill will be brought by the new partner. There are different methods. Sometimes goodwill is paid by the new partner privately to the old partners. In that case, no entry will be passed in the books of accounts. Sometimes goodwill will be brought in cash and that goodwill is retained in the business. Sometimes the goodwill is brought in cash by the new partner and the goodwill will be withdrawn by the old partners. Sometimes goodwill is not brought in the books of accounts, but the old partners will raise the goodwill in capital account itself. Without bringing any cash, the goodwill is adjusted in the capital accounts. So different methods are there for treating goodwill when the new partner is admitted. Next comes revaluation of assets and liability. When a new partner is admitted, the assets and liabilities of the firm may be revalued. That means the assets value is less. Now the old partner ABC will say that the present machinery value is only 1 lakh rupees in the balance sheet. But if we sell the machine, the present value is 1,50,000. Now we have to increase it. The machinery account data to revaluation, a new account is opened. Similarly, furniture. The present value of the furniture in the balance sheet is 1 lakh rupees. Partners say we have to bring down the value of furniture to 70,000. That means 30,000 rupees we have to decrease. The entry will be revaluation account data to furniture account. So if we want to increase the asset, debit the asset. If you want to decrease the asset, credit the asset. Similarly, if you want to increase the liability, credit the liability. If you want to decrease the liability, debit the liability, the corresponding entry will be completed by using revaluation account. So after making all revaluation, we have to see whether revaluation profit or loss. That profit or loss will be shared by the old partners in the old ratio. Next one is adjustment regarding accumulated profits. So before a new partner is admitted, there may be some accumulated profit like general reserve, P&L account in the balance sheet of the old partners. So before the new partner is admitted, the reserves, accumulated profits will be shared by the old partners ABC in the old profit sharing ratio. So entry general reserve account data, profit and loss account data to A's capital, to B's capital, to C's capital. By passing this entry, the accumulated profits will get closed. Next, change in profit sharing ratio. When a new partner is admitted, definitely the old ratio will get changed into new ratio. So a new profit sharing ratio has to be calculated when the new partner is admitted. Adjustment of capital account in proportion to profit sharing ratio. Sometimes the old partner says that when a new partner is admitted, our profit sharing ratio has changed. Now we recalculate our capitals according to new profit sharing ratio. So if any further capital has to be brought, the old partner has to bring further capital. If an old partner's capital shows more capital, that excess amount will be refunded by the firm to the old partner. The old partner's capital accounts are adjusted according to new profit sharing ratio. These are the possible adjustments which are to be made at the time of admission of a partner. Now, treatment of goodwill. Just now I told you the main complication on admission of a partner is regarding treatment of goodwill. It depends on the situation, whether the partner is bringing in cash or not, whether he is paying, recording in the books of accounts or paid privately. Right. If it is paid privately, no entry. If he is bringing in cash, then we have to pass the entry. Sometimes the old partners will withdraw the goodwill from the business. Sometimes goodwill is not brought in cash, but adjusted in the capital account themselves. In that case, new partner's capital account data to old partner's capital account. Like this, we adjust it. Now, sacrificing ratio. Now, see here. When a new partner is admitted, the old partner will sacrifice some amount of their share of profit in favor of the new partner. Example, ABC are the new partners. Or let it be A and B are two old partners. A and B are two old partners. A new partner is C is admitted. Earlier, A and B used to share the profits half-half, 50-50. Now, when C has also been introduced, the profit sharing ratio of A and B will get decreased. That means they will sacrifice a part of the profit in favor of the new partner. So, we have to calculate the sacrificing ratio. The sacrificing ratio is old ratio minus new ratio. Sacrificing ratio is old ratio minus new ratio. So the goodwill will be adjusted in sacrificing ratio in case of admission of a partner. Retirement of a partner. One aspect we have completed, admission. Now we are coming to the retirement. Sometimes an old partner is retired from the business. Again, some adjustments are to be made in the accounts when a partner is retired. The first aspect is again regarding goodwill. Goodwill is adjusted at the time of admission and also at the time of retirement. That means the share of goodwill of the retiring partner should be paid. Normally, the retiring partner's goodwill is adjusted in the capital accounts. That means if A, B, C, three partners were there and C is retiring, A and B are remaining. So in that case, the entry will be A's capital account debtor, B's capital account debtor to C's capital. Because C is retiring, he is to be given goodwill. His account is credited. A and B's account is debited. Adjustment of goodwill in capital accounts on retirement of a partner. Apart from goodwill, again revaluation of assets and liabilities, how we have done at the time of admission, same way we have to do the entries on retirement. Same accumulated profits are there, it will be distributed among all the partners. Like that adjustment we have to make. And at the time of retirement, the amount due to retiring partner will be transferred to his loan account. C is retiring, so whatever the amount due to C will be transferred to his loan account. Now he is no more a partner. We cannot say C is capital, C is loan account. Next comes treatment of goodwill on retirement. Just now I told you, at the time of retirement, goodwill has to be treated, adjusted in the capital accounts. Gaining ratio. Just like sacrificing ratio. Sacrificing ratio will be calculated when a new partner is admitted. When a new partner is admitted. Similarly, when an old partner retires, gaining ratio will be calculated because the old partners will gain. Earlier, the profits are shared by three partners A, B and C. In future, only two partners will share A and B. That means remaining partners are going to gain on the retirement of C. So gaining ratio will be new ratio minus old ratio. New ratio minus old ratio. So gaining ratio will be calculated on retirement. Sacrificing ratio will be calculated on admission. Next comes death of a partner. Last topic is death of a partner. On the death of a partner, again adjustments have to be made. That means the entries on retirement or death is same. The only difference is the retirement will be a pre-planned action. That means before retirement only C will give notice to the other partners A and B that I am going to retire on so and so date. So already it is pre-planned. Normally retirement will be done on the last date of the financial year. So easily we can settle the accounts. But death will occur at any time. At any time death will occur. So at the time of death, again the partners have to decide. For example, A, B, C, three partners are there. C dies. Then on the death of C partner, A and B has to find out what is the share of all the profit as well as capital of C and transfer that amount to the legal representative or legal heir of C. Not only the share of capital, share of profit, but also any other amount, goodwill or any other amount which is due to C will be transferred to C's legal representative account. This is it. So these are the points on partnership account 1. Now partnership accounts 2, second unit I am going to discuss now. Partnership, dissolution of firm and sale to a company. It's a very small chapter. The dissolution of firms. When the partnership firm business comes to an end, when the partnership firm when the partners decide that we will stop our business, we'll stop the activity, all the business activity, will wind up the business. So at the time of winding up the business, all the assets will be sold, cash realized, paid all the liabilities and settle the account of the partners. So 3 things we have to do on dissolution of firm. First, selling all the assets, realizing the cash and paying all the outside liabilities and settling the accounts of the partners. So at the time of dissolution of firm, what we'll make is, we'll make an account called realization account. realization account. We transfer all the assets to realization, all the liabilities to realization. We'll find out what is the profit or loss on realization. That realization profit or loss will be transferred to the remaining partners. That means partners capital account. That is accounting treatment on dissolution. Insolvency of a partner. Insolvent means when a person's liabilities are more than assets. It is called insolvent. Example A, B, C. 3 partners are there. C has become insolvent. An amount is due to the firm from C. C has become insolvent. He cannot bring the cash. So whatever the loss of insolvent partner will be borne by solvent partner in the capital ratio. This is according to Garner versus Murray rule. An English case is there. In that case, the rule is given when one of the partner has become insolvent, the loss of insolvency will be shared by the solvent partners, will be borne by the solvent partners in their capital ratio just before insolvency. If any other partner, any solvent partner's capital account shows debit balance, then he will not bear the loss. For example, A, B, C, D, 4 partners are there. D has become insolvent and the amount due from D is 1 lakh rupees. This 1 lakh rupees loss because of insolvency of D will be borne by A, B, C in the capital ratio. Suppose if the capital of C is showing a debit balance, then C will not bear the loss. A and B will bear the loss. And one more thing, according to Garner versus Murray rule, the solvent partners have to bring cash equal to their share of realization loss. Equal to their share of realization loss. The solvent partner has to bring the cash. Right? So these are the rules in Garner versus Murray rule on insolvency of a partner. Last topic is sale to a company. Sometimes a partnership business is converted into a company, or a partnership from business, the partnership is selling its business to a company. Then the procedure will be same as that of dissolution of firm, because here firm is being completely wound up and all the assets and liability of the firm are taken over by a joint stock company, by a company. So in that case, the partnership firm will get the consideration called purchase consideration from the company, and this purchase consideration will be shared by the partners. That means the business is transferred from partnership business to joint stock company. That's all. So this is the end of unit number 2. So I explained you the first topic, that is partnership accounts. 1, what is partnership, what is the meaning of the term partnership, what are the features of partnership, what are the methods of maintaining the capital accounts, then profit and loss appropriation account, admission of partner, what are the adjustment regarding admission of partner, regarding the goodwill and sacrificing ratio, retirement of partner, death of a partner. Now second unit I have explained you dissolution of a firm. Well, on the dissolution of a firm, the complete firm is dissolved, all the assets are sold, liabilities are paid, and accounts are adjusted, partners' accounts are closed, sale to a company. That's all. So this is the end of 2 units. So next we will discuss about the company accounts. Now the third unit is company accounts. In this company accounts, the topics we are going to cover up: issue of shares, debentures, underwriting and bonus shares. So first of all, what is the meaning of the term company? A joint stock company is an artificial person created by law. It exists only in the contemplation of law. It is invisible but exists. It does not mean that it is not visible, we cannot see it, so it does not exist. No, it exists. It contemplates in the eyes of law. So it is a person. It's an artificial person. So what are the characteristic features of the company? First characteristic feature, it's an artificial person, right? Second feature, a company, there is a separation of ownership and management. The owners of the company are shareholders, but the management of the company is in the hands of board of directors. The board of directors will, run the company on behalf of shareholders. The minimum number of members and different types of company. In a private company, minimum number of members are 2. Maximum number of members are 200. Private company. For public company, minimum number of members are 7. Maximum, there is no limit at all. Then one of the feature is perpetual succession. The members may come and go, but the company will go forever, continuously. That means even if there is a death of a shareholder, it will not affect the company. The company will continue as usual. Then the liability of the shareholders. The liability of the shareholders is limited, unlike in case of partnership. In case of partnership, the liability of partner is unlimited. But in case of shareholders, the liability of a shareholder is limited to the extent of amount invested in the company. So these are some of the features of a joint stock company. Now, kinds of companies. There are different types of companies. We can classify the companies into different categories. First one, company limited by shares. A company limited by shares is that company where the liability of the shareholder is limited to the extent of amount unpaid on the share capital. If any unpaid amount is there on their share capital, that much is the only liability of the shareholders. That is called company limited by shares. Company limited by guarantee. Normally these are service companies whose objective is not to earn the profit but to provide the service. So for these companies, the shareholders will guarantee that on the event of happening of an event like wound up, when the company is wound up, we will contribute so and so amount to the assets of the company. So only undertaking is given by the shareholder that at the time of winding up, I will pay so and so amount to the company. That is called company limited by guarantee. Unlimited companies. It's a sort of company where the liability of the shareholder is unlimited. The next comes foreign company. A company which is not incorporated in India. It is incorporated outside India but having a place of business in India. It's called foreign company. Government company. Any company whose paid up capital, whose not less than 51% of paid up capital is held either by the central government or state government or by both the governments. It's called government company. That means not less than 51%, 51% or more. The share capital is held either by the central government or state government or both. It's called a government company. 1% company. If only one person is the owner of the company, it is called a one-person company. Statutory company. A company which is made by passing a special act in the parliament, like RBI, LIC, Indian Railways. These are called statutory corporations. The company which is formed by passing a special act in the parliament or state legislature, it is called statutory company. Private company. A company which has 3 conditions. The 3 conditions are, first of all, limits the number of members to 200. Any company where the maximum number of members are only 200, not more than 200, it's a private company. Secondly, restricts the transferability of shares. That means the shares of a private company are not freely transferable. Not freely transferable in the market. Third one, prohibits an invitation to the public to purchase the shares. A private company cannot invite the general public to come and purchase their shares. So if these 3 conditions are there, limits, restricts, prohibits, then it is called a private company. If any one of the 3 conditions is violated, then it will become a public company. Example, a company whose number of members are more than 200, it's a public company. A company whose shares are freely transferable in the market, it is called a public company. A company which invites the general public to come and purchase the shares, it's a public company. So these are the different types of companies. Now, classes of shares. The 2 types of shares are there, preference shares and equity shares. Shares are called preference shares when it is having two preferential rights. The preferential right is they will get preference in paying the dividend. That means a company must first pay the dividend to preference shareholders. After paying the dividend to preference shareholders, then only it can pay the shares, the dividend to other shareholders, equity shareholders. They are having the preferential right to get the dividend first. Secondly, at the time of winding up of the company, the preference shareholders will have a right to get the capital returned before any return of capital to equity shareholders. So, if the shares carry these two rights, getting preference of dividend, getting preference of return of capital at the time of winding up, it is called preference shares. Equity shares. Equity shares are the ordinary shares. That means they will get the dividend only after payment of dividend to preference shareholders. Similarly, at the time of winding up, equity share capital may get the capital only after capital is returned to preference shareholders. So, these are equity and preference. Types of preference shares. Preference shares are classified into different categories. The first one, cumulative and non-cumulative preference shares. The preference shares are cumulative if the dividend in a particular year is not paid, then that dividend will get accumulated. In the next year, both dividends will be paid, last year dividend, current year dividend. That means if in a particular year dividend is not paid, that dividend will not lapse. In the coming year, accumulated dividend will be paid, that is called cumulative preference shares. But if the provision is there in the articles, then only the shares will be cumulative. Otherwise, non-cumulative. That means in a particular year, if dividend is not paid, that dividend will be lapsed. The dividend will not get accumulated. That is called non-cumulative. Participating. Participating preference shares means if the preference shares are having the right of any surplus amount left after making a particular dividend to equity shareholders. Suppose a company has decided that we will give the dividend to equity shareholders only 20%. So 20% dividend has been paid to equity. After that, still some profit is left. In that profit, if preference shareholders also having the right, it is called participating. Otherwise, it will be non-participating. Similar is the case at the time of winding up. If at the time of winding up, all the share capital to preference shareholders, equity shareholders are returned, even after returning to equity shareholders, some assets are still left with the company. If it is participating preference shares, the participating preference share will have the right on the leftover assets also. So if the problem is silent, if the company is silent, then it will be treated as non-participating. That means preference shareholders will not have any right on surplus profit or surplus assets. Next comes convertible. Convertible preference shares are those preference shares which can be converted into equity shares after a period of time. Non-convertible, the non-convertible will never be converted into equity, always it will be preferential. Then redeemable, irredeemable. Redeemable means the company will take back the preference shares after a period of time. Example, one company has issued preference shares stating that these shares will be redeemed after 10 years. So as soon as 10 years are completed, the company will call back, redeem the preference shares and repay the amount to the shareholders. That is called redeemable. Irredeemable preference shares, the company will never take back the preference shares. So these are the different types of preference shares. Now differences between equity shares and preference shares. See here, both the shares are entirely different. The characteristic features are different. The first equity and preference difference is the rate of dividend on preference shares are fixed, whereas the rate of dividend on equity share is not fixed. It may fluctuate. They may get or they may not get. They may get low, they may get high, but preference shareholders rate is fixed. Second difference is, first of all, dividend should be paid to preference share. Later on, dividend can be paid to equity share. Next one is, preference shares may be redeemable, may be irredeemable. But equity shares, always it will be irredeemable equity shares. Next comes at the time of winding up. At the time of winding up of the business, First of all, preference share capital should be returned. Later on, if assets are there, then only equity capital will be returned. One more difference is equity shareholders will have a voting right in the meetings of the company, whereas normally preference shareholders will not have the voting right. So these are some of the differences between equity shares and preference shares. Next, classification of share capital. The share capital will be classified into authorized share capital, issued share capital, subscribed, called up, paid up. Authorized capital is the maximum capital which a company can raise from the public by issuing the shares. It is also called nominal capital, registered capital. It will be written in the memorandum of association that the company is incorporated with so and so capital. That is called authorized, maximum capital, not more than that. Then issued capital is that part of authorized capital which is actually issued by the company to the public. Example, a company has registered its company with a capital of 10 lakh shares. 10 lakh shares of ₹10 each. 10 lakh shares of ₹10 each. This is the authorized capital, maximum capital. Now the company has decided to issue only 4 lakh shares. The maximum capital 10 lakh, but the company has decided to issue only 4 lakh. So these 4 lakh shares are called issued capital. So 4 lakh shares are issued, but the public has purchased only 3 lakh. That is called subscribed capital. 3 lakh shares are only public has purchased, subscribed capital. Then called up capital. Each share the face value is suppose 10 rupees, but the company has called up only 8 rupees. Only 8 rupees company has called up. So this is called called up capital. Paid up capital, some of the shareholders may not pay the call money. It is calls in arrear. So we deduct calls in arrear from the called up capital. From the called up capital, deduct the calls in arrear, we'll get the paid up capital. These are the different classification of capital. Next, calls in arrear and calls in advance. Calls in arrear means the company has made the call to the shareholder, but the shareholder has not paid yet. The shareholder has not yet paid. It is called calls in arrear. The calls in arrear will be deducted from the called up capital. From the called up capital on the liability side. Then calls in advance. Sometimes calls will be paid in advance. This will happen when oversubscription is there. For example, you have applied to the company for 100 shares, but the company has allotted you only 40 shares. You have given the application money to the company for 100 shares, but the company has allotted to you only 40 shares. The excess application money which you have given to the company will be treated as calls in advance, and that money will be adjusted towards allotment money and call money. That is called calls in advance. Issue of shares at par, premium and discount. There are 3 methods of issuing of shares by the company. Shares may be issued at par value or premium or discount. Par value means face value. If 100 rupees is the face value of share, the company is issuing at 100 rupees, par value. If 100 rupees share, the company issues at 120 rupees per share, it is called premium. If 100 rupees shares are issued at 80 rupees per share, it is called issued at discount. Next comes pro rata allotment of shares. Pro rata means proportionate. Sometimes there will be oversubscription of shares. Example, a company has issued the shares 1 lakh to the public, but the application from the public has come for 1,20,000 shares. It is called oversubscription. The company cannot all 1,20,000 shares the company is having only 1 lakh shares, but the applications have received for 1,20,000 shares. Now there are different methods. How to allot the 1 lakh shares for 1,20,000 applications? So normally we'll go for pro rata allotment, proportionate allotment. That means no application is rejected. We will allot 1 lakh shares for the applicants of 1,20,000 shares in the ratio of 10:12. That means for every 12 shares applied, 10 shares will be allotted. For 1,20,000 shares applied, we issue 1 lakh shares. pro rata allotment. For example, if you have applied for 120 shares, if you have applied for 120 shares, given the application money to the company for 120 shares, the company will allot you 100 shares. Only 100 shares you are getting. You have applied for 120 shares. It is called pro rata allotment. That means the excess application money which you have given for 20 shares, that will be adjusted by the company towards allotment money and call money. This is called pro rata allotment. Forfeiture and reissue of shares. Forfeiture means cancellation of shares. Suppose if the shareholder has not paid the call money, then after giving due notice, the company will cancel his shares. It is called forfeiture of shares. So whatever amount the shareholder has paid, that will not be returned back. That will be kept in a new account called shares forfeited account. And these forfeited shares may be reissued to any other person. Right? Then debentures and its features. Next topic is debenture. Debenture is an instrument of debt. A company can raise the debt from the public just like raise the capital. There is a lot of difference between capital and debt. Capital is owner's fund, whereas a debt is a loan. So a loan may be taken by the company from the public or from the financial institution by issuing a document called debenture. A debenture is an acknowledgement of debt given by the company under its seal, that we have taken a loan from so and so person, we will pay interest at so and so rate to that person. So this acknowledgement of debt is called debenture. It's a long-term fund. Debenture issue will be issued for a long period of time. The features of debenture: first of all, debenture is a debt. It will carry interest. It will be issued for a long period of time. The debenture holder will not have a right of voting. The debenture interest is a charge on the profit. Whether the company earns profit or loss, the company has to pay interest on debentures. Last one, differences between shares and debentures. There are many differences between shares and debentures. Shareholders are the owners of the business. It's a part of capital. Share is a part of capital of the business, whereas debenture is a debt, is a part of debt, total debt. So when a person purchases shares, he will get the dividend. When a person purchases debentures, he will get interest. Dividend paid is an appropriation of profit, whereas interest paid is a charge on profit. If a business is having profit, then only the company will pay the dividend. Even if a company is incurring loss, then also the company has to pay interest to debenture holders. Debenture holders are outsiders, whereas shareholders are the owners of the business. So normally the shareholders will have a right to take part in the conduct of the meetings. They can vote, whereas debenture holders will not have the right to vote. They are outsiders. So these are all the differences between shares and debentures. So we have completed up to half of this third unit, that is issue of shares and debentures. Still three more topics, that is underwriting of shares, bonus shares, valuation of goodwill, valuation of shares, and company final accounts. These are the things we have to discuss. Come on, now we'll start the next topic in our discussion, that is underwriting of shares and debentures. Underwriting of shares and debentures. Actually, according to Companies Act, when the company has issued the shares within the stipulated period, it should receive the minimum subscription. If the minimum subscription is not received within the stipulated time, the company should wind up all the activities, return the capital to the shareholders, return the subscribed capital to the shareholders. That means within the stipulated period only, the company has to receive the minimum subscription, which is normally the 90% of the total, issued capital. So if the company fails to get the minimum subscription within the stipulated period, then the company has to be wound up, closed. Whatever cash received from the shareholders, that should be returned back. The proceedings of the company will be wound up. So to avoid that, the company will enter into a contract with underwriters. So underwriting is an agreement between the company and the underwriters. The underwriters will promise that if the public does not purchase the shares within the stipulated period, we will purchase it. So they will give this guarantee. So for giving this guarantee, the company has to pay commission to the underwriters. The company has to pay commission to the underwriters. They are giving the guarantee. If the public has not subscribed the shares within the stipulated period, the underwriters will come and purchase the shares in their own name, so that the company will be survived. The company will not be wound up. So as a precautionary measure, the company enters into an underwriting contract. So according to SEBI, underwriting contract is not mandatory, but the company will enter into this underwriting contract to protect themselves, that the company will not face the risk of winding up. So when the company enters into an underwriting agreement, it is sure that definitely the company is going to survive, the company is going to continue. The only thing is the company has to pay commission, underwriters commission. That is underwriting. Then bonus shares. When shares are issued free of cost to the existing shareholders, it is called bonus shares. Now the question arises, why the company issues bonus shares? A prudent company will make reserves. Every year a part of the profit will be kept in reserve. Over a period of times, the reserve will get accumulated. Actually, reserve money is the share of profit, part of profit, which is not distributed among the shareholders in the form of dividend, but company has retained that profit in the form of reserves. So over a period of time, the reserve will get accumulated. Now the company wants to capitalize the reserves, convert the reserves into share capital by issuing free shares to the existing shareholder. Example, you are the existing shareholder. Already you are holding 100 shares. Now the company will declare that for every 100 shares, 10 shares we are issuing free of cost. So now you will get 10 shares free of cost by the company. The company will issue 10 shares to you. Now you will become the shareholder of 110 shares. These 10 free shares the company has issued from the reserves. That is called bonus shares. The bonus issue can be made in two ways: in converting the partly paid shares into fully paid, or fully paid bonus shares. In this way, bonus issue will be made by the company. Now, guidelines issued by SEBI for issue of bonus shares. Whenever a company wants to issue bonus shares, Securities and Exchange Board of India, this body has given the guidelines. Only after following the guidelines, the company can be able to issue the bonus shares. In these guidelines, the conditions are given that the company must get a certificate from the statutory auditor that the terms and conditions regarding bonus issue are satisfied. The bonus issue will not affect the rights of partly paid or partly convertible or fully convertible debentures. The bonus issue can be made only from free shares, from available shares, free shares. That means general reserve, etc. Not specific reserve. Only free reserves the company can utilize for issuing bonus shares. Revaluation reserve cannot be used for declaring bonus shares. Similarly, share premium account received in cash, that can be used. So general reserve, P&L account, all these things can be used. Secondly, no free bonus shares can be issued until and unless partly paid shares are converted into fully paid shares. And another provision is the articles of association must contain a provision that the company can issue bonus shares. Lastly, once bonus shares has been approved by the board of directors, it should be implemented within 2 months from the date of resolution passed for issuing bonus shares. So these are the guidelines which are issued by SEBI whenever a company wants to issue bonus shares. Now, reserves that can be used for issuing bonus shares: general reserve, P&L account balance, capital redemption reserve, security premium account. These are the free reserves which can be used for declaring bonus. What is the effect of bonus shares? The reserves will get decreased and share capital will get increased. There is no effect on the asset side of the balance sheet. No effect on the asset side of the balance sheet. Only reserves are decreased, share capital will increase. So this is the procedure for bonus shares. Next thing is company final accounts. The final accounts consist of profit and loss statement and balance sheet. New format of making profit and loss statement and balance sheet is given by the Companies Act 2013. Now it is not made in traditional form, it is made in a statement form. We will not write profit and loss account, it's a profit and loss statement. A statement form, we have to make the income statement. So in statement form, first we take the income, revenue from operations, other incomes, only two. All the incomes will be divided into two categories: revenue from operations, other income. Then expenses we normally divide into five categories. That is cost of material consumed, employee benefit expenses, finance cost, depreciation, and other expenses. These are the five items we'll take under expenses. So incomes 2 items, expenses 5 items. Income minus expenses will get profit before tax. From that we deduct the income tax, we'll get profit after tax. Like this, in the statement form, we will prepare the profit and loss statement. Now balance sheet. Balance sheet will also be prepared in a statement form, where first we take equity and liabilities, shareholders fund, share capital, reserves. These 2 items will come under shareholders fund. Non-current liabilities. Under non-current liability, we'll take long-term borrowings, debentures. Then we take current liabilities, consist of trade payable, short-term provisions, short-term loans and advances, other current liabilities. Now we take the total. So 3 items are there: shareholders fund, non-current liability, and current liability total. Then below that we'll take the assets. Under assets we'll take non-current assets, fixed assets. Fixed assets are again divided into tangible fixed assets and intangible fixed assets. Then non-current investments, then we'll take current assets. Current assets will take inventories, account receivable, cash and cash equivalent, other current assets. Like this, in this format we have to make the balance sheet of a joint stock company. So not much theory is there in this company final accounts. We have more problems. The theory is there on other topics, but company final accounts we will focus. You should focus only on problems, preparing the profit and loss statement and balance sheet. Now we'll come to the next topic called profit prior to incorporation. Prior means before. Incorporation means registration. So any profit earned by a company before incorporation is called profit prior to incorporation. So according to Companies Act, a company cannot earn the profit before incorporation. Company will come into existence after incorporation. So before incorporation, how a company can be incorporated? This will happen. This may happen. How it may happen? Now see here. A company will take over the business of a sole trader before the date of incorporation. For example, a sole trading concern is being sold on 1st January 2020. 1st January 2021. 2020 is a dangerous year, that's why I'm not going to repeat 2020, 2021. 1st January 2021, a sole trading business is being sold. And this business is going to be taken over by a company which is not yet incorporated. The company has applied for incorporation. The company got the incorporation certificate on 1st April 2021. But the company has taken over the business from 1st January. So January, February, March, these 3 months the company was not in existence, but the company is running the business of sole trader. The company got incorporation from 1st April, from 1st April onwards. The company closes the accounts on 31st December. Now, the question arises, what will happen to the profit before incorporation from 1st January to 31st March? These 3 months profit. This 3 months profit is called profit prior to incorporation. And the profit earned after 31st March from 1st April, the profit is called after incorporation profit. That is company profit. The profit earned before incorporation is a capital profit. That profit is not available for declaring dividend. And profit earned after incorporation is a revenue profit. It is available for declaring dividend. Now question arises, how to find out the profit before incorporation? There are 2 methods. First method, we close the accounts. First we have taken up the business from 1st January. We will close the accounts on 31st March. We find out how much is the profit or loss up to 31st March for 3 months. Then from 1st April onwards, new financial statements will be prepared for 9 months. So instead of 1 year accounts, we are preparing 3 months account and 9 months account. 3 months accounts are pre-incorporation, 9 months account are post-incorporation. But it seems very simple, but practically it will be difficult, because at the time of preparing the accounts, we have to close the business. Stock taking has to be done, physical stock taking. That means for a few days the business has to be shut down. Then only we can be able to close the account. It's difficult, impractical if we close the accounts during the year. That's why what will happen? Second method. The second method says we will prepare the accounts for the whole 12 months. Whole 12 months. So in this case, what we'll do? We'll make one trading account to find out the gross profit for the whole year, for 1 year, 12 months period. The one gross profit we get. After getting the gross profit, we calculate two ratios, sales ratio and time ratio. Sales ratio means how much are the sales before incorporation, how much are the sales after incorporation. Example, the sales before incorporation are 4 lakh, after incorporation 8 lakh. So before incorporation total sales 4 lakh, after incorporation 8 lakh, so 4:8, 1:2 is the sales ratio. Second, time ratio. How many months are there before incorporation and how many months after income? 3 months before, 9 months after. So 3:9, 1:3 is the time ratio. So we calculate sales ratio and time ratio. So first we prepared trading account, we got the gross profit. Now we have calculated two ratios, time ratio and sales ratio. Now we prepare profit and loss account by segregating pre-incorporation and post-incorporation. Some expenses, first of all, gross profit. The gross profit will be divided between pre-incorporation and post-incorporation in the ratio of sales. In the ratio of sales. Secondly, there are some expenses which are related to sales. Example, sales commission is there, advertising is there, bad debts are there, sales promotion is there. These are related to sales. So these expenses are divided in the ratio of sales ratio. Some expenses are related to time. Example, rent paid, salary paid, electricity bill paid. These expenses are related to time. So these expenses are divided between pre and post in time ratio. Some expenses are exclusively post. Example, debenture interest, preliminary expenses, completely post. Some are exclusively pre, like partner's salary, interest on capital, etc. Completely pre. Like this, we divide all expenses between pre and post on some basis. We calculate pre-incorporation profit. Profit before incorporation. This is the method of finding out profit prior to incorporation. The next topic is valuation of goodwill. Last two topics in this chapter is valuation of goodwill and valuation of shares. So first of all, meaning and features of goodwill. Goodwill is an intangible asset. It exists, but we cannot be able to see it. Just like land and building, plant and machinery, by using fixed assets, our earning capacity will increase. So goodwill will also increase the earning capacity, but the thing is we cannot be able to see, we cannot be able to touch. So goodwill is one thing which distinguishes between new business and old business. A new business will not have the goodwill, an old business may have the goodwill. So goodwill is the reputation, good name of a business. It will be created over a period of time. Due to, on account of goodwill, the earning capacity of the business will be more. A business will earn more profit on account of goodwill, on account of reputation. The goodwill will attract new customers and old customers to the business. So this is goodwill. So goodwill can easily understand, but it is difficult to define in specific words. Simply, it is the good name or reputation. Now, feature of goodwill is, first of all, goodwill is intangible, we cannot see. Secondly, by having goodwill, the earning capacity of the business will increase. The goodwill may fluctuate from time to time. Always the goodwill will not remain same. Goodwill is inseparable from the business. We cannot keep our business ourselves and sell the goodwill. No, we cannot sell the goodwill. Goodwill is attached with the business. It will go along with business. Next is, the calculation of goodwill is a subjective matter because there are different methods of calculating the value of goodwill. Now, which factor will affect the goodwill, we cannot say. So many factors are there which contribute to the creation of goodwill. That is goodwill. Now, need for valuation of goodwill. Why we need to calculate the goodwill? Only under certain circumstances goodwill will be calculated. Example, sole trading concern. A sole trader will calculate the goodwill at the time of selling the business. If I am running my own business, sole trading business, there is no need to calculate business if I am running. There is an intention to sell the business. Now there is a need to calculate the goodwill. Similarly, in case of partnership firm, when a new partner is admitted, old partner retires, if one of the partner dies or change in the profit sharing ratio, there is a need for calculating goodwill. Similarly, in the case of amalgamation, when two or more firms are amalgamated, there is a need for calculating goodwill. Like the different circumstances are there, we need to calculate goodwill. Now, methods of calculating goodwill. There are three methods of calculating goodwill: average profit method, super profit method, and capitalization method. In average profit method, we simply calculate the average profit of the past few years. Example, you are having a sole trading concern, you are selling the business. I am the buyer. I will tell you, we calculate goodwill according to average profit of your business of the last 5 years. The last 5 years average profit we calculate. To average profit we multiply number of years expected in future that I'll get the benefit. I am purchasing your business, so I will get benefit of your name for the next 5 years. So whatever average profit I will get, that will be multiplied by 5 years to get the value of goodwill. So goodwill is equal to average profit into number of years of purchase. That is according to average. Super profit method. Goodwill is equal to super profit into number of years of purchase. So what is super profit? Future maintainable profit. Future maintainable profit minus normal profit. FMP minus NP is equal to SP. Super profit. So first we need normal profit. For calculating normal profit, we need capital employed into NRR. Capital employed means how much is the net worth of the business. Take all the assets present value minus outside liabilities, we get capital employed. Half of the profit of the current year we deduct to get average capital employed. So average capital employed into NRR, normal rate of return. The rate of return which other firms are earning in the same business, that is called NRR. So average capital employed into NRR is equal to normal profit. FMP, future maintainable profit. That is the past average profit adjusted for future changes. Past average profit adjusted for future changes, that is called FMP. So FMP minus normal profit, you will get SP, super profit. Super profit into number of years of purchase will get goodwill according to super profit. Third one is capitalization method. Under capitalization method, the same procedure, super profit method only will calculate. So goodwill is equal to super profit divided by NRR, normal rate of return, into 100. So super profit divided by normal rate of return into 100, you will get goodwill by capitalization method. So this is the complete explanation regarding goodwill. The last and final topic is valuation of shares. What do you mean by share? The part of the capital of a company. A part of the capital of a company is called a share. Example, a company consists of 10 lakh rupees share capital. 10 lakh rupees share capital of 1 lakh shares of rupees 10 each. The total 10 lakh rupees is divided into 1 lakh part. Each part is of rupees 10. So that part is called share. Now, meaning of valuation of shares. At different circumstances, a person has to calculate the value of share. There are different meaning of the term value of share. Face value. The value which is fixed by the company is called face value of the share. It will remain fixed. Secondly, market value. The market value of share means the value at which the share is bought and sold in the stock exchange. That is called market price. That depends on demand and supply of shares. Thirdly, intrinsic value. Intrinsic value means the value of share which is based on the net worth of the business, assets and liabilities of the business. Yield value, the value which is based on the earning capacity of the business. That is called yield value. So there are different connotations of the term value of shares. Face value, market value, intrinsic value, yield value, like that. Need for calculating the value of share. Why we need to calculate the value of share? Different circumstances are there. First of all the shares will not be quoted in the stock exchange. There are some shares which are unlisted. Unlisted means the shares are not traded in the stock exchange. For those shares, if you want to sell, If we want to purchase, we need the value of share. Similarly, the shares of private limited company. The shares of private limited company are not dealt in the stock exchange. Now there is a need to calculate what is the value of this private limited company share. Similarly, when two or more companies are amalgamated, there is a need for calculating the value of share. Similarly, for wealth tax and income tax purposes, we need to calculate the value of share. So different circumstances are there where we have to calculate what is the value of share. Now, factors affecting valuation of shares. For calculating the value of shares, capital employed. How much is the capital employed in the business? Capital employed means total of assets minus outside liabilities. Earning capacity or profitability of the business. What is the rate of profit earned by the company on capital? Rate of return earned by the company on the share capital. That is called earning capacity. Last one, normal rate of return. The rate of return which other firms are earning in the same industry. Other firms are earning in the same business. That is called normal rate. These factors are considered while calculating the value of share. Last one, methods of valuation of shares. Three methods are there: net assets method or intrinsic value method, earning capacity or yield basis, fair value method or dual method. Net assets method means we take the total present value of all assets minus outside liability minus preference share capital. We'll get amount available for equity shareholders. Amount available for equity shareholders divided by number of equity shares. We'll get intrinsic value. Net assets method. Secondly, earning capacity or yield method. In this we calculate what is the expected rate of return. The expected rate of return divided by normal rate of return into paid up value per share. Expected rate of return divided by normal rate of return into paid up value. This will give you earning capacity share. Last one, fair value. Fair value is simply the average of intrinsic value and yield value. Intrinsic value plus yield value divide by 2. You will get the dual value or fair value of the share. That's so in this video I have explained you the theoretical concept of all the topics under advanced accounting subject. So by watching this video, definitely you will get a good grasp on the conceptual clarity of all the terms. So after listening this lecture, you can be easily able to write the questions, theory questions in examination. So all the best for your preparations, and if you are satisfied with my lecture, give a like to the video, share it among your friend circle, so that more students can be able to watch the videos. Give your comment on these lectures, and lastly, don't forget to subscribe my channel.